Today, the Fed's inflation mirage. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. Well, the Federal Reserve System in its current form was created back in 1935. That's the same time as its Washington headquarters was built as a project to create jobs in the Great Depression. The Fed's mandate is to keep the economy about right so that it can produce maximum employment, but not so hot as to set off runaway inflation. And what the Fed has done traditionally is to use economic models to predict inflation and then raise interest rates to sort of ease the brakes before inflation happens. Many would argue that they've used a warped inflation measure, conveniently excluding, for example, the real costs of housing, and they use, of course, interest rates as a lever. The question is, does this work and will it work? Well, they recently changed their approach because in the last couple of inflation cycles, it never really moved up as unemployment went down. They reached 3.5% unemployment, which is a 50-year low for much of the last 2 years before the pandemic, but inflation didn't get anywhere close to their target. They've really missed it again and again. And so now they believe that they can afford to wait to see actual real inflation appearing before they move interest rates. Now, they don't want to see inflation go materially above 2%, but they will look through short-term blips, seeking, a move to moderately above 2% for some time so that it averages 2% over time. And when they get that, they'll raise rates, and they say this won't happen for some time. And they also argue that the globalization of the economy and technology has enabled manufacturing to take place all around the world, so it's very hard for people in wealthy countries to raise prices or to raise wages. It's hard for workers to raise wages when wages can move overseas, suggesting that wages growth will be sluggish for some long time. And of course, in real terms, many have not seen any wages growth for years in the US or indeed elsewhere. And they've also been pumping massively the liquidity into the system to try to prop up the financial system, still going at around 80 billion each month, and the balance sheet is bigger than it's ever been. So the question really is this: has the Fed miscalculated, with the massive QE programs plus the Biden stimulus measures driving inflation way higher? Or are the measures that they're taking, such as taking rates much lower and essentially buying bonds from the market, actually deflationary? Much of the commentary is based on the expectation of more inflation sooner, with some thinking back to the high rates we saw in the 1980s, when, of course, wages growth was very strong. Every time I discuss this issue, by the way, 95% of the comments assume raging inflation is coming. A minority still prefer the deflation thesis. Now, I still tend towards that view, but want to stress the outcomes are less than certain, which is a problem for those banking on a specific outcome. The inflation-deflation debate has been raging, with fears of faster CPI playing out across duration-heavy assets from bonds to tech stocks. But overnight, on Tuesday, we had the latest US inflation measures, which both increased by more than forecast back in March from the US Bureau of Labor Statistics. The Consumer Price Index for March rose by the most in more than 8.5 years, kicking off what the majority of economists expect will be a brief period of higher inflation. That said, investors speculated that the acceleration was not fast enough to warrant any Federal Reserve policy change. The drop in yields weighed on bank shares. Consumer prices shot up in March, given a boost by a strong economic recovery and year-over-year comparisons to a time when the COVID-19 pandemic was about to throttle the US economy. The Consumer Price Index rose 0.6% from the previous month and 2.6% for the same period a year ago. The year-over-year gain is the highest since August 2018 and was well above the 1.7% recorded in February. The index was projected to rise 0.5% on a monthly basis and 2.5% from March. The report is the clearest indication so far that the signs of mounting inflation evident in business surveys and producer prices are feeding through to stronger consumer prices, wrote Michael Pierce, a senior US economist at Capital Economics. For all the focus on supply disruptions pushing goods prices higher, the strongest upward pressure on prices is coming from the services sector. But actually, gasoline prices were the biggest contributor to the monthly gain, rising 9.1% in March, and it was responsible for about half the overall CPI increase. Gasoline was up 22.5% from a year ago, part of a 13.2% increase in energy prices. Food nudged higher as well, up 0.1% for the month and 3.5% for the year. The food at home category increased 3.3%, and all 6 of the government's measures of grocery store indices rose, with the biggest gain of 5.4% in the category of meats, poultry, fish and eggs. Food away from home increased 3.7%, while limited service meals, which includes pickups, takeaway and delivery restaurants, jumped 6.5% for the year. That's the largest annual increase in the survey's history, right back to 1997. That big surge on a year-on-year basis resulted from what economists call the base effect, or the lower level used for comparisons. In March 2020, the government had just begun a massive shutdown of US businesses that ultimately would see more than 22 million Americans on the unemployment line. Core CPI, which excludes volatile food and energy costs, increased 0.3% over the month and 1.6% year over year. While the inflation numbers look high, many economists, as well as policymakers at the Federal Reserve, expect the increase to be temporary. April likely will also show a sharp rise, but then the numbers are supposed to decrease as the worst months of the shutdown fall out of the data comparisons. Fed officials have said they won't adjust policy based on short-term jumps in inflation regions, and Chairman Jerome Powell told this again on the CBS 60 Minutes at the weekend. He doesn't expect any interest rate hikes this year. Still, markets have been pricing in higher growth and inflation, with government bond yields rising to their highest levels since before the pandemic. The economic reopening and the unprecedented levels of government support are contributing to the inflationary environment, and Fed officials see GDP growth this year around 6.5%, which would be the fastest increase since 1984. In reaction, US stocks climbed to record highs and bond yields fell as investors bet that a higher than forecast rise in inflation won't be enough to slow economic stimulus measures. A lot of growth and inflation have already been priced into the market, said Emily Rowland, co-chief investment strategist at John Hancock Investment Management. It's almost as if you need to exceed those expectations in order to see more pronounced reaction from the markets. Although policymakers at the Federal Reserve expect a bump in consumer prices to be short-lived, many traders disagree. Treasury extended gains after the government's auction of 30-year bonds was greeted with strong demand. But despite the US March CPI coming in at 0.6% month over month and 2.6% year over year, which was higher than expected, there was absolutely no rocking the boat movements. And with the FOMC taking a more activist stance to manage labour markets, the reaction in the US yield market suggested US data doesn't mean much for policy normalisation until maybe September or beyond, based on the Fed's new approach to managing inflation, which opens the door perhaps to more risk-taking in the short term. The US 10-year yield spiked 1 basis point, then quickly dropped back to where it was at 1.6780, and the dollar reaction was even more telling, with the euro-US dollar sliding down, quickly recovering and then going slightly higher. The US dollar index was down 0.34% to 91.83. All of this, frankly, was so well telegraphed, including Jay Powell on 60 Minutes over the weekend, that the market reaction and tail risk would have been more to a soft inflation number rather than a stronger one. And in fact, the S&P 500 closed at an all-time high, even after the US recommended a pause of the Johnson & Johnson vaccines amid health concerns. The drug maker's shares hit a one-month low before recovering some losses to close around 1.3% down, as calls for pausing the use of its COVID-19 vaccine after 6 women developed rare blood clots dealt a fresh setback to efforts to tackle the pandemic. The US anticipates, though, having enough other vaccines during that period. The tech-heavy Nasdaq was also at a record, while the Dow Jones Industrial Average finished in the red. In fact, in one of the year's quietest sessions, high-flying technology names that had flourished during the coronavirus-induced lockdowns last year attracted renewed buying, boosted Apple, Microsoft and Amazon. The trio gained between 0.6% and 2.4%. The Dow Jones Industrial Average fell 0.2% to 33,677. The S&P 500 gained 0.33% to 4,141. And the Nasdaq Composite added 1.05% to 13,996. The markets have been skittish about rates for some time, said Mike Lograt, Managing Director of Investment Strategy at E-Trade Financial. While this may cause some short-term volatility, investors have been pretty steadfast in their faith in a full economic recovery. The volatility index reflected the lack of market jitters and went to a fresh 14-month closing low of 1665. This year, 20 had proved to be a bit of a flaw, but what we've seen from the start of this month is the VIX going down through that level and establishing its trading range in the mid-teens, which is notable for the broader risk environment as we enter earnings season, said Greg Bootle, the US head of equities and derivatives at BNP Paribas. Gold was down 0.09% to 1,746. Silver was down 0.21% to 25.37. Copper was up 0.02% to 4.0697. And crude oil was at 60.52, which was up 0.56%. The Stocks 600 index was at 435.74, and the iShares Russell 2000 ETF was down 0.26% to 221.14. The S&P 500 futures was down 0.05% to 4,130. The Nasdaq futures was down 0.07% to 13,966. Ethereum was up 7% to 2,288. And Bitcoin was up 5.53% to 63,210. Fund managers across the world now see inflation, a taper tantrum, and higher taxes as bigger risks than COVID-19, according to the latest Bank of America Core Survey. But my point is this: I'm not sure that we can bank higher inflation as a dead cert. It might happen, but I do believe a lot of this information that we're seeing at the moment is temporary, partly because of the baseline problem, and partly because of short-term variations in prices for some goods and services. But the question really is there really any structural inflation coming? And my own view still is that the deflationary arguments are more powerful than many actually give credit for, despite the fact that it's a less than popular view. And if in fact deflation is the outcome, despite more quantitative easing and more fiscal stimulus, then a lot of people are going to be badly out of place. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.